and welcome to our viewers from around the world. This is Business Incorporated, live to you from Channels Television in Lagos. I'm Bolaji Akinwale. Coming up in the program, the World Trade Organization predicts difficult times ahead if the UK exits the European Union. Many economies strained as governments seek new funding options. Plus, a look at activities at the local bond market. We'll begin with the news that the UK outside the European Union would face uncertain trade relations. According to the World Trade Organization's Director General Roberto Azevedo, Britain would not have the same negotiating leverage as the EU. Britain could have to impose £9 billion worth of additional tariffs on imports, raising the cost of living. Exporters could face an extra £5 billion of tariffs on their sales abroad. Now, these figures for additional tariffs on goods going into or out of the UK come from the WTO analysis of preferential trade arrangement. Under the WTO rules, member countries are generally supposed to apply the same level of tariffs to goods wherever they come from. But there are exemptions for preferential regional and bilateral trade agreements. Asian markets closed mixed on Wednesday amid a muted reaction to China's May trade data. But the energy sector got a boost after oil prices settled above $50 a barrel on Tuesday for the first time in nearly 11 months. The Nikkei 225 reversed morning losses to close up 16,830.92 points after the yen weakened against the dollar. The dollar-yen pair traded at 107.06. Chinese mainland markets closed lower, with the Shanghai Composite down 9.34% at nearly 3,000 points. In Hong Kong, the Hang Seng Index was down 30.36 at 21,297.88. And in South Korea, the Kospi advanced 15.45 points to over 2,000. In Australia, the ASX 200 finished flat at 5,369.97. And while the Asian markets were mixed, European markets opened lower this morning. Let's take a look at how the markets are faring at this time. Conrad Busin, DWT, the Channels TV correspondent, joins me from the Frankfurt Stock Exchange. Conrad, welcome to the program. European stocks posted strong gains by Tuesday's close as a rise in oil prices and the latest comments from Fed Chair Janet Yellen boosted investment sentiments in that market. However, they opened lower on Wednesday amid concerns over the health of the global economy. Is there any silver lining in today's session?
Well, Bulaji, it's not an all doom and gloom day here today, despite the downswing of the German stock market today. We got a report from the United Kingdom saying that industrial production there rose 2% in April compared to the month of March, a surprisingly strong increase that none of the economists had predicted as much. Also from Japan, economic growth numbers were reported to be stronger than anticipated. And what also could be considered as some sort of silver lining is that the European Central Bank starts buying corporate bonds as well today, a measure to increase liquidity in the economy, and that's of course meant to give economic activity and inflation a boost. But you're right, these are silver linings at best. Most of the factors influencing the market today are negative. The World Bank lowered its growth forecast for the world economy this year. It also is talking about a potential financial crisis looming because the World Bank sees the problem of very high debt levels worldwide. Of course, this is a perspective that's not bound to, cause a positive mood on the trading floors.
Some level of uncertainty seems to lie ahead if the UK prepares for a referendum whether to remain in the EU or not. How are the markets preparing for the possible outcome of their votes?
There are very few clear indicators that show us how the markets are getting prepared for a potential Brexit. The price of the pound sterling, the British pound, compared to the euro, has lost around about 6% since the beginning of this year. But of course it's not very easy to consider how much of this has to do with concerns about a potential devaluation of the pound after a Brexit. We cannot read investors' minds, and when they are talking to us journalists about their motivations, sometimes they're only giving us half of the truth. One indicator, a bit clearer than the exchange rate of the pound sterling, are the prices for very special financial derivatives, futures contracts you can buy as a financial investor or also as a business. Those futures make sure that you get assured a certain exchange rate of the euro against the British pound for an extended period of time. And the prices for those futures have been rising considerably and continuously in recent weeks. And this is clearly a sign that there are investors and business people out there that want to get protected against a potential devaluation after a Brexit. Apart from this, markets are getting prepared for a potential Brexit by discussing it at length. They are considering all the potential implications of a Brexit on the economy, on politics here in Europe, on other places in the world. When there's a lot of discussion, there's also a lot of undecisiveness among investors, and that contributes to a certain amount of reluctance among investors to really go out there and decide on long-term and sustainable investments.
Now, the U.S. presidential nominations are almost concluded with the announcement of Hillary Clinton as the Democratic candidate. Are there any reactions from the market at this time?
Well, not so much in terms of prices, but of course in terms of statements. Hillary Clinton is considered to be a more stable, reliable candidate for the presidency than her Democratic competitor Bernie Sanders, who keeps talking about bashing Wall Street, bashing the banks, and who keeps using the word revolution a lot. That's not the sort of wording that conservative financial people like. So there is a positive bias towards Hillary Clinton, but let's not forget this is only one step on the path towards the presidency. Also, commentators of financial and business papers and media are predicting a very nasty run-up to the election between Hillary Clinton and Donald Trump. So it's quite probable that also this step of Hillary Clinton becoming the presidency candidate is only one more factor to contribute to the discussion about the topic, to the insecurity about the outcome, and, well, just like Brexit, one more thing to be concerned about for people on the markets.
Conrad Busen from the Frankfurt Stock Exchange, thank you for your time.